In March 2024, Fetch.ai, SingularityNET, and Ocean Protocol announced the formation of the Artificial Superintelligence Alliance. The pitch proposed combining three distinct components of decentralized AI: Fetch's autonomous agents, SingularityNET's AI marketplace, and Ocean's data sovereignty infrastructure, all governed by a single token. 18 months later, Ocean Protocol has withdrawn from the alliance, and the remaining merged token has experienced a 96% decline in price. This exit culminated in an acrimonious lawsuit, settled in early 2026, which revealed that a founding member converted and sold a massive tranche of tokens without public disclosure. To determine if this merger created a unified, high-utility ecosystem or simply consolidated fragmented liquidity, we have to examine the on-chain supply and governance data. This alliance was positioned as a heavyweight in decentralized AI, or DAI, a sector attempting to build permissionless, blockchain-based alternatives to centralized AI models. When high-profile DAI protocols merge, analyzing the resulting on-chain supply mechanics and governance failures is the only reliable way to separate tangible technological value from marketing narrative. Despite the alliance name, all participating tokens were initially consolidated under the FET ticker. The allocations for incoming AGIX and Ocean holders make up 56.17% of this newly merged supply. These allocations represent community token swaps for existing holders, rather than new supply granted to insiders. To understand the cost of this integration, look at this FET token supply chart. Absorbing the Ocean community required minting roughly 600 million entirely new FET tokens. While necessary, this immediate minting caused active dilution, shrinking the network ownership percentage of original Fetch.ai believers. Looking ahead at the project supply dynamics, the full token unlock schedule for founders extends all the way to 2050. A 24-year vesting schedule means emissions will continue for longer than most Web3 projects survive. Making the supply picture even less clear, the migration is still not finished. AGIX and Ocean tokens continue to trade independently on exchanges. The alliance has not documented a public deadline to finalize these token conversions. The mechanics of the merger structurally diluted early adopters up front, while the lack of a conversion deadline leaves the final circulating supply in a state of unresolvable uncertainty. As shown in this architectural model, Ocean Protocol originally served as the alliance's dedicated data sovereignty layer. Their specific contribution was a compute-to-data capability, allowing developers to train AI models on encrypted datasets without exposing raw information. Then, in October 2025, Ocean Protocol abruptly withdrew from the alliance, alleging governance failures and a misalignment of strategic vision. Before exiting, the Ocean Foundation converted 661 million of their native tokens into 286 million FET. Looking at the price and volume history, we can see the impact of what happened next. The Ocean Foundation liquidated approximately 263 million of those FET tokens onto the open market without public disclosure. That single sell-off represented over 10% of the entire circulating supply. The community only learned about this transaction months later through a lawsuit filed by Fetch.ai. The legal action eventually resulted in a $120 million settlement in early 2026.
The fact that a founding member was structurally able to liquidate a tenth of the network in secret and walk away within 18 months raises serious questions about the alliance's internal controls. Losing Ocean Protocol eliminated the merger's strongest data privacy feature, and the massive, undisclosed token dump exposed severe flaws in how the alliance managed its governance. We have to evaluate what the remaining components, Fetch, SingularityNET, and the validator group CUDOS, actually allow you to do with the FET token today. Currently, it's used for network staking, registering agents on the Agent-First platform, paying for inference on ASI Cloud, and purchasing services on SingularityNET. On the infrastructure side, staking secures the Fetch Hub 4 chain. Delegators distribute tokens across up to 70 validators, yielding an annual percentage rate between 5.5% and 8%. However, evaluating the product side is difficult. Neither Agentverse, ASI Cloud, nor the SingularityNET marketplace publishes verifiable adoption or revenue metrics. Keeping network usage volumes hidden is a major concern, particularly for a combined ecosystem that promotes components claiming to be live since 2017. To address supply concerns, the Alliance launched an Earn and Burn program in January 2026, designed to act as a deflationary measure. This pie chart visualizes the total FET supply. In the first execution of the program, only 5 million FET were actually destroyed. That amounts to just 0.18. The Alliance has published a white paper outlining a proposed next-generation tokenomics model intended to solve these structural issues. This design transitions the network to a two-tier model, separating the base ASI token from a yield-bearing derivative called staked ASI. Looking at this proposed economic flow, target yields of roughly 11% would be funded entirely by real network fees and buybacks, bypassing inflation. During periods of market stress, staking emissions hibernate while the burn rate dynamically increases. The foundational prerequisite for this entire system is a planned convergence layer, a block DAG network called ASI Chain. Currently, the Alliance has not announced a timeline for the ASI Chain mainnet launch. The math behind these next-generation tokenomics is well designed, but until the underlying blockchain actually goes live, the entire model remains theoretical. The original thesis for the Artificial Superintelligence Alliance required 3 distinct technical capabilities working in tandem to offer a viable alternative to centralized AI. With the exit of the dedicated data layer, the remaining components, an agent platform, an AI marketplace, and a validator set, overlap more than they complement each other. The on-chain data and governance history indicate that the Alliance is not currently compounding synergistic network value. Until ASI Chain launches and the project reformulates internal controls, the Alliance merely consolidates fragmented liquidity across older projects, bound by a heavily diluted token. This analysis is from Own Your Mind, ownyourmind.ai, an independent research platform covering decentralized AI. No sponsors.